Hey everyone, it's Mayhem. It's time for another episode of Mayhem's Macro Monday here on Monday, October 10th, 2022. This Mayhem's Macro Monday is brought to you by TraderAid.com. We're for retail, by retail, trying to help traders and investors navigate these markets with a focus on fundamentals, macro, and technicals. The first chart we have for you is the nasty year 2022 has been for stocks. So far, set to become one of the worst years since the Great Financial Crisis. And since the Great Financial Crisis, this has been the worst year for the market if it's to close as it is now or worse. So this is an interesting chart because what it's really showing us is the depth of the selling. It is somewhat unusual. Now, what we also see is often is the case in prior years where we've had heavy selling, that by the end of the year, that market wasn't down quite that much. Will that be the case in 2022? We don't know. A lot of things are pointing against that, like persistent inflation, an aggressive Fed, and, of course, recessive economic forces. The next chart I have here is a chart looking at participation in funds. So we're looking at equity flows versus the sort of world stock market index. We can see the world stock market index has plummeted, but investors are resilient. They're not giving up the ghost. And why does that matter? Because during the Great Financial Crisis, as well as during what led up to the COVID crash, we saw a lot of investors cashing out. This time around, however, we saw the most aggressive allocation into stocks without that capitulation out of stocks, despite a pretty unforgiving bear market. So what does this mean to us as longer-term investors? To me, it means that we aren't out of the woods yet. I'd really like to see individual investors exiting funds en masse to say that some of that sort of capitulatory pressure is behind us. Because otherwise, if we do get a big event risk or a leg down or other kinds of volatility drivers, we could see that exit and it could foment a deeper sell-off. So because prior trends all the way going back to the dot-com bust and prior to that as well have seen an exit by retail, who right now holds the greatest percentage of their net worth in equities ever. And also that same percentage held by retail is the largest percentage of GDP ever. So it is likely the Fed looks at these metrics and says they need to deflate the wealth effect bubbles that exceedingly easy monetary policy has created. And they're looking at these flows as well to see whether or not that's actually starting to happen commensurate with their policy goals, because they do want to see people shrink their exposure to equities, to real estate, to other asset classes, and for those assets to be reduced in value as well, commensurate with the policy goal of destroying demand to try to reduce the velocity of inflationary pressure. We can see that the liquidity from central banks has gone into negative year-over-year territory, which is a big deal, especially when we look at sort of the prior times that this has happened, to include the December 2018 tightening tantrum. And because there's a delayed impact, because this is year-over-year, it's important to look at it from the sense that some of these things are going to have a little bit of a lag time. So even though you see that dip into negative liquidity or negative velocity of central bank liquidity early in 2019, it really was starting as early as 2017 in the later months when they began that first real attempt at quantitative tightening. And that December 2018 tightening tantrum, where the market, I believe, peak to trough was down about 19%, so just narrowly escaped being considered a bear market. But a lot of that had to do with quantitative tightening and rate hikes, creating a atmosphere where risk off was the name of the game. And it was pressure that we saw, especially in risk assets. And I think that we're seeing similar now, but it's more broad-based. We're not just seeing high pressure in risk assets. We're seeing high pressure in bonds. We're seeing high pressure beginning to build against real estate. The other thing that I'd like to rewind our memories on is that both times, both in the peak of the crypto market in November of 2017, which was around the same time the Fed really started to get more aggressive about tightening, we saw a significant sell-off in crypto, I think from around 20,000 down to the single thousands. And then this time around we saw from around 65, 66,000 down to just about 18,000, and we may not be done yet because the velocity of central bank liquidity continues to go lower and lower year over year, which is telling us that these assets or things that may resemble assets like crypto, anything that is correlated with an abundance of liquidity with low to negative real rates, is going to be under pressure in this type of an environment. And so the most speculative stuff, you can see that peak of velocity of liquidity happened in early 2021. That was the same time that we saw the peak in the most speculative parts of the market, like ARK and SPACs and some of this other sort of very highly speculative, growthy, unprofitable tech. And that really matters a great deal because the reason those things were bid up so aggressively in the first place, in part, was there was enough liquidity to pretty much bid up everything under the sun. And as that liquidity began to peak and then turn the other way in velocity, we saw that the riskiest had their liquidity removed in a more rapid fashion, I guess you could say. The riskiest assets had the liquidity removed first and foremost, and then as you go down a spectrum of risk, you saw more and more stocks impacted until we finally got to the mega caps. And they often say the generals are last to fall, but they certainly are falling now. And this chart has a lot to do with why, and we're going to talk a little bit more about that. But I wanted to bring this chart up because it's one that's not often looked at, and yet it's so important to know where we are in the cycle. And this chart is telling us in no uncertain terms that we're at the end of the cycle. The credit cycle has ended by virtue of central banks taking their toys and running away with them, and those toys are the things like quantitative easing and ultra low rates, of which we don't really have either anymore. And the consumer is not doing well in this environment. One of the things that we're seeing is the combination of inflation and rising rates has consumers taking on more and more debt. That debt is becoming more expensive. And on top of that, and it makes a lot of sense, the savings rate is falling precipitously because it's just costing more and more to participate in this economy. And wages in real terms, when adjusted for inflation, are not rising. They're actually falling. So the falling savings rate with falling real wages matters. Now, why do I say real wages? Because nominal wages are going up, and that means that the number of dollars people are paid is increasing. But does that really matter if their costs are going up faster? And that's one of the reasons that this savings rate is falling as well. So spending is rising in nominal terms, but people are getting the same amount of stuff for more money. And that's going to be pretty negative for their ability to have a piggy bank, so to speak. Bears and bulls since 1926. Look at all this. The average bull market rises 162% over 51 months, or just over 4 years, 4 years and a quarter. The average bear market falls 41% over the course of just shy of 2 years. So that would be 1 year and 8 months. Why does this matter? Well, because if this bear market is anything like the others, we've only fallen 25% over 8 months. So we could have a lot longer to go, especially with a Fed that has said in no uncertain terms they wish to keep tightening through 2024 when they expect PCE, their favored measure of inflation, to become closer to their policy goals. So they're not looking for prices to fall. They're looking for the velocity of price increases to slow. That's the Fed's goal, which means that we're in a pretty sticky situation because all they can do is subdue demand. They can't increase supply. And in order to subdue demand commensurate with their policy goals, they have to induce a recession, and probably a rather brutal one. They've said to expect pain. They've talked about falling asset prices. They've said a lot of things the Fed has never said before. And I understand they're being increasingly transparent, but we also have to look at this from the standpoint of investors and traders. They are saying, look, if you fight us, you're going to lose. So that brings me to the next chart. Central banks are the market. We can see in no uncertain terms that there is a strong positive correlation between the balance sheet of global central banks and the performance of the S&P 500. The S&P 500 is falling as the balance sheet of global central banks is falling. And this is one of the reasons why there's that old mantra, don't fight the Fed. We don't fight the Fed for a very specific reason. Because the Fed decides where we are in the credit cycle by virtue of their policy. So let's look at that. The last 6 bear markets saw bottoms arriving when the Fed cut rates. Why does that matter? Because we're in the opposite situation now. The Fed is hiking rates, which means there's an increasing danger against risk assets, and in this case, bonds and real estate as well are set to suffer more because the Fed is not done with their tightening cycle. They haven't seen inflation fall. They're seeing that as the primary policy objective, to subdue inflation. And they've already said that the labor force needs to soften, that the economy needs to slow to a pace that is slower than what trajectory or trend is. And they've said that they really do think that markets need to come down. Some of the speakers have said that they were surprised that markets reacted the way they have to the Fed, and they're pleased to see them begin to price in a more hawkish Fed. So that's all I have for everyone today. I hope this is really helpful for you navigating the week ahead and just looking back at some of the things that we've been paying attention to. If you don't already, check out TraderAid.com. Consider subscribing for as little as $19.99 a month to get these types of macro insights as well as fundamental and technical insights from our team of experts. And remember, this is not a market where there's any reason to trade more than you have to. I see a lot of people hurt because they feel like they have to trade every 5 seconds. They always have to be in the market. There's no reason for that. Only take the trades where there's favorable reward over risk. Don't do things that don't comport with your comfort levels. If you're staying up all night because of your portfolio's exposure, you're too exposed. Think about staying in for the long run. You're running a marathon, not a sprint. So that's all from me, Mayhem. Remember, again, this whole thing is made possible by TraderAid.com. We appreciate your support. If you enjoy the content, like and subscribe to the YouTube. Check me out on Twitter as well, Mayhem4Markets, Mayhem number 4 Markets. Thanks again for tuning in. I'll catch you next time.